To the big story on Trading Hour, and that's got to be the stake sale of Rapido via Swiggy. Gaurav Malhotra, Executive Director, Axis Capital, is now with us on the show. Gaurav, morning. This is Rima here. So, we've been talking about the news since morning. They've sold the entire 12% stake. They've got about 2,400 crore rupees. So, if you could just tell us now, what will Swiggy's balance sheet look like? The cash on the books vis-a-vis the projected cash burn going ahead, and will Swiggy require more of a fundraise?
Yeah, hi, good morning, everyone. So, see, the company had around 5,300 crores of cash end of June quarter, and they have raised 2,400. So that's around 7,700 crores, almost close to $1 billion. In terms of the projected cash losses, see, the cash losses in Instamart should start coming down. They sort of peaked in the first quarter. Food delivery continues to be profitable. And even from a capex perspective, the company has slowed its dark store expansion. So we expect the cash burn to come down, and this fundraise to meaningfully expand the runway, which the company has had, say, before this fundraise. So on the whole, we think it's a positive thing. This is something which the company actually had quite candidly disclosed also in the first quarter results.
Do we have cash burn numbers? Because just comparing, Swiggy's near $1 billion, 7,700 crore versus Eternal's 18,000 crore plus, nearly 19,000 crore rupees. There's clearly a big difference.
Yeah, see, the thing is, Instamart was burned around 870 crores of cash last quarter. That number will definitely come down this quarter. Plus, like I said, food generates around, say, 200, 300 crores of cash. Plus, capex has come off quite meaningfully. So on a quarterly basis, the cash burn is not as much. See, versus Eternal, obviously, the cash situation is much better. Food is significantly more profitable. The loss in Blinkit is much lower. In fact, Blinkit is likely to turn EBITDA break even in the next couple of quarters based on our projections. So from that perspective, yes, Eternal is much ahead, but this obviously does help, Swiggy from a near to medium term perspective. We do feel that maybe it would not harm if they do some additional fundraise in the foreseeable future. But this in itself should be good for them from a meaningful runway and a growth perspective.
Gaurav, good morning. Thank you for joining in. So, by the looks of it, do you believe that Swiggy is currently falling behind the quick commerce expansion race in comparison to Eternal? Because Eternal has laid out its targets very clearly for Blinkit, that they want an X amount of stores in this period of time, regardless of the fact that whether they turn profitable or not in this business. So, would an additional fundraise further propel Swiggy? But because how much of this fundraise would also help in expanding more dark stores for Instamart?
See, so the company had essentially mentioned that once post reaching around, say, 1,000, 1,100 stores end of 4Q, they will slow down their store expansion. And Blinkit, like you rightly said, has sort of gone ahead. It initially was targeting for 2,000 stores by end of December of this year, and now they're sort of talking about a 3,000 number, not end of this year, but more from a medium term perspective. So from that, yes, Swiggy definitely is on. The expansion plans are much slower. I think so. What this fundraise could potentially do is that maybe they sort of change their plans and sort of little bit accelerate the expansion, but I don't think so they'll go back to what they were doing, say, in December or even the March quarter. But maybe they increase a little bit. And do also note that, in terms of from a cash situation perspective, Rapido is also sort of getting into food delivery. So it's always good to have some dry powder. Whether you need it or not, it's a separate matter, but it's always good to have some dry powder when there is these imponderables of Rapido, Flipkart Minutes, Amazon Now, those guys are still sort of, ramping up as we speak.
Got that. Can you explain the rationale of transferring Instamart to a wholly owned subsidiary? They're planning to hive it off. What is the rationale behind it and the implications for Swiggy?
See, the thing is, to be honest, it just cleans up the structure, right? It's almost, think of it like a Blinkit Blinkit eternal structure that now Instamart will be a separate subsidiary. Now it increases the flexibility. Now what that flexibility could mean can be a variety of things, but which many of them may or may not happen. So I think so. It's just like cleaning up and cleaning up the structure more than anything else. I don't think so. This really changes how they do business. It really doesn't mean anything from a from how to think from a financial estimates perspective.
So you don't think that they will now move to an inventory-led working model, or they're looking at strategic partnerships or an eventual listing of Instamart? I mean, should shareholders start thinking about that, or it's too far down the line? And does it alter your estimates of Swiggy valuation?
Right now they are thinking of the first step is to hive off. Then we'll see how it sort of comes through. But like I said, it opens up avenues for you to do things in terms of corporate action if you want to do some specific fundraise or any of such things. But from a earnings perspective, nothing really changes from our side.
So you believe that despite this slowdown in their dark store expansions, that would not accelerate their path towards profitability, at least firstly on an EBITDA level and then on a PAT level. What are the kind of timelines that you have projected for Swiggy to turn positive, both on the EBITDA and on the PAT front?
At an aggregate level, it'll take some time for the company to break even. But food is anyway, like I said, is profitable. Instamart, in terms of contribution margin, we expect it to turn break even sometime in the middle of next fiscal. EBITDA break even for Instamart will take a little bit longer. But the way to think about it is that because of his dark store expansion very rapid, his throughput per store went down to below 1,000 in the March quarter, in the June quarter, which is roughly 1,400 for Blinkit. So even if he does not do as much of a dark store expansion, at least in the near term, it does not constrain his ability to grow at a very rapid pace.
Great conversation, Gaurav. Thank you very much for joining in. Had some more, but we're out of time. We need to slip into a very short break. But here's a quick reminder. Catch the exclusive CNBC-TV18 CEO Centimeter from the CII National Council meeting in a short while from now. 80 CEOs on one platform discussing rupee, rates, trade relations, the GST cuts, and so much more. You don't want to miss this.